Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Arvinas Inc. quarterly report. Arvinas Inc. is a clinical-stage biotechnology company that specializes in the development of therapies to degrade disease-causing proteins. The company's primary focus is on creating proteolysis-targeting chimeras, PROTAC, targeted protein degraders that utilize the body's natural protein disposal system to eliminate harmful proteins. Arvinas' pipeline includes several promising candidates, including ARV-102 for neurodegenerative diseases such as Parkinson's and progressive supranuclear palsy. The company is also developing treatments for various types of cancer, including pancreatic, colorectal, and non-small cell lung cancer through its ARV-806 program targeting the Kirsten-Rat sarcoma protein. In addition to cancer therapies, Arvinas is working on treatments for other diseases, such as relapsed/refractory non-Hodgkin lymphoma, NHL, with ARV-393. The company's portfolio also includes vepdegestrant, an estrogen receptor degrader for the treatment of locally advanced or metastatic ER+/HER2 breast cancer. Furthermore, Arvinas is developing bavdegalutamide and luxdegalutamide, two investigational orally bioavailable PROTAC protein degraders for the treatment of men with metastatic castration-resistant prostate cancer. The company has established collaborations with several major pharmaceutical companies, including Pfizer Inc., Genentech Inc., F. Hoffmann La Roche Limited, Carrick Therapeutics Limited, and Bayer AG. Arvinas therapies are designed to harness the body's natural protein disposal system to eliminate disease-causing proteins, offering a promising approach to treating various diseases. With its diverse pipeline and collaborations with leading pharmaceutical companies, Arvinas is poised to make significant contributions in the field of biotechnology. Arvinas Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. Arvinas Inc. trades at a lower price-to-book ratio of 1.39 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 40% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This also raised the question if that management is diluting shareholders to sustain the business. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. If the business does not improve its revenue and generate positive cash flow, the company will continue to struggle to cover its cost and interest expenses. This combination makes the investment case highly unfavorable unless earning issue is addressed. On top of the cash-burning business, shareholders are consistently diluted. I may be wrong, but I would suggest to stay away from such investment for now. The primary drivers of revenue growth or decline for a company can be attributed to various factors, including milestone payments from pharmaceutical companies such as Pfizer and Novartis. Milestone payments are one-time payments made upon achieving specific goals or milestones in clinical trials or product development. Revenue growth is driven by significant upfront payments, contingent payments, and sales-based milestones from these partnerships. For instance, the company received a $50 million payment from Pfizer and up to $1.4 billion in contingent payments. Additionally, regulatory milestones from Pfizer and Novartis contributed to revenue growth. The company also benefited from tiered royalties on net sales of PROTAC targeted protein degrader-related products. On the other hand, revenue decline can be attributed to decreased revenue from collaborations such as the vepdegestrant, ARV-471, collaboration agreement with Pfizer. This decrease in revenue was offset by certain amounts owed to Yale University pursuant to the amended license agreement. The company also experienced a revenue decrease of $173.2 million compared to the same period in 2025. The net income of the company underwent significant changes over the years. Initially, it decreased by $147.6 million due to accounting estimate adjustments. This decline was followed by a further decrease of $3.1 million, resulting in a net loss of $4.4 million. The situation worsened in 2025 when the company failed to generate any net income, with operating losses being substantial. The profit margins also experienced a downturn. Although exact figures were not provided, it was evident that revenue decreased substantially from $188.8 million to $15.6 million. This decline was likely influenced by restructuring charges and the net loss incurred by the company. The lack of product sales revenue in 2025 meant that there was no clear indication of a change in profit margins during this period. The company's financial performance indicates a concerning trend in its ability to generate cash from its core operations. According to the provided data, the company is experiencing negative operating cash flow, with a significant deficit of $44.4 million in 2026. This is further confirmed by references on pages 49 and 50, which also highlight the company's struggles in generating positive operating cash flow. The negative operating cash flow suggests that the company is not able to cover its expenses from its core business activities, indicating potential issues with efficiency, pricing, or cost management. This trend may have significant implications for the company's long-term sustainability and ability to invest in growth initiatives. The company has experienced a significant reduction in its debt levels and interest expenses over the past year. According to the financial summaries, the outstanding loan balance decreased from $0.6 million on December 31, 2025 to $0.5 million on March 31, 2026. Similarly, the overall debt level also saw a decrease from $0.7 million to $0.5 million during the same period. The net interest expenses have also shown a notable decline, decreasing by $2.1 million in 2026 compared to 2025. Furthermore, the company's long-term debt repayments remained stable at -$0.1 million for both years, indicating that the company has been able to manage its debt effectively. Overall, these findings suggest that the company has made significant progress in reducing its debt levels and interest expenses, which is a positive trend for the company's financial health. Management is optimistic about the company's outlook due to several factors. Favorable clinical trial results and FDA approval of vepPANU have contributed to this optimism. The joint plan with Pfizer to commercialize and further develop vepdegestrant is also a significant factor. Additionally, multiple product candidates are progressing through clinical development programs. Management plans to continue investigating ARV-102 in neurodegenerative diseases associated with LRR-K2 and endolysosomal dysfunction. They will share additional biomarker data from the Phase 1 clinical trial in patients with PD in 2026 and initiate a Phase 1 billion clinical trial in PSP in the U.S. in the second half of 2026. The company is also exploring new areas, such as PROTAC-mediated degradation, which has the potential to address historically undruggable targets like BCL6. Initial clinical data will be shared in 2026, and enrollment in the dose expansion cohort of the Phase 1 clinical trial of ARV-806 will begin. Management expects significant operating losses for at least several years and will need substantial additional funding to continue operations. They do not expect to generate revenue from product sales in the near future. However, they are on track to receive a $50 million development milestone payment in connection with FDA approval of vepPANU. The company's research and development expenses are expected to increase substantially for the foreseeable future as ongoing clinical trials progress. General and administrative expenses will also increase due to personnel management and infrastructure development. Overall, management is focused on advancing product candidates through clinical trials and preclinical development while managing expenses and securing additional funding. The financial overview of a company. A review of the company's financial records reveals some key points. Firstly, the company has chosen not to pay out dividends to its shareholders. This decision suggests that the company is prioritizing reinvestment in its operations and growth over distributing profits to investors. In terms of share buybacks, there is no information available on this topic. It appears that the company has not engaged in any significant share repurchase activities. That concludes the financial summary for Arvinas Inc. Feel free to comment below, and I will be happy to answer them when possible.